Hello friends, good evening to all of you and credit and the counterparty risk. Now what is counterparty risk? What do you mean by the counterparty risk? When the counterparty's obligations is not completed by them, they're not able to complete their obligation. That is the counterparty risk, right? And if we talk about the credit and the counterparty risk, so market value, basically markets do value the credit risk of issuers and the borrowers. So whosoever the issuers are there, whosoever the borrowers are there, definitely if they default in their obligation, definitely the credit risk will be there, right? Like credit risk of trade debt would be related to what? Like such as bonds, debentures. These are the debt instruments. Now, do you know what you mean by debt instruments? In this case, the market is here, the company is here XYZ. Now, the company is having the different ways to get money from the market. Like they can borrow from the bank. The company may be borrowing from the bank in the form of overdraft or term loan or loan against property or anything like that, right? Or they can be borrowing from the creditors or sorry, from the vendors, like from where they are getting the raw material. They can be borrowing from them also for the shorter duration, right? That is creditors trade creditors are there, or it could be related to account payables, right, where the amount is to be paid. And also they can be issuing the equity, but it's not a debt. They can be issuing the equity and get the money from the market investors, or also they can be issuing the debt instruments. They can be issuing the debt instruments. Like for short term duration, they can be issuing the commercial papers. For the long term durations, they can be issuing the bonds. They can be issuing the debentures. Now, the bond or debentures are basically acknowledging the debt. They are acknowledging the debt. So let's say case investors are there. A, B, C are investors who have invested into the bonds. Now they are basically looking for some return. Now the company is going to pay them a fixed return that is said to be coupon, right? So let's say case a bond is there, rupees 1000, where a coupon rate is of 10% and it is having the maturity after 5 years. So what will be the cash flow? The cash flow would be something like this. Let me draw the timeline. 1, 2, 3, 4, and 5. First year, second year, third year, fourth year, and fifth year. At the end of the first year, the investor will be getting the coupon, which is always calculated on the face value or at the par value. So here is a coupon rate 10%, and it is to be coupon is to be calculated on the face value, right? That is rupees 1000. So the investor will be getting rupees 100 in the end of first year, second year, third year, fourth year, and fifth year. And the end of the maturity, the investor is also will also be able to get the face value of the instrument, that is rupees 1000. So the investor will be getting these cash inflows. So these will be the cash inflows in case of bonds, right? So that's the scenario related to the bonds. When we'll be solving the numerical related to the duration, we'll be covering these things in detail. That's why I'm giving an idea related to it. Okay. So the credit risk could be related that the investors have invested the money into these bonds, right? And the company defaulted, and the company defaulted. That is going to be what? That is going to be the credit risk. That is going to be the credit risk. Now, this credit risk is basically this. How we do look into the credit risk? This is being indicated by the credit rating, right? So there are credit rating agencies like Moody's, Fish, right, Samera, and S&P. So many credit rating agencies are there, CRAs are there. Those do rate the instruments of the companies or the corporates. Based upon the credit rating, we get to know that if this corporate is good one or not, and based upon that the rating would be there. Like there are some bonds called junk bonds. Some bonds are junk bonds. Now in case of junk bonds, the interest rate would be lower one or higher one? Kindly do reply here. In case of the junk bonds, the rate of interest would be the lower one or on the higher side? It will definitely be on the higher side. Why on the higher side? Because there is much risk involved in case of the junk bonds, right? So it could be the case related to that these corporates are defaulting, so the credit risk is there. And credit risk may be arising on the account of the issuer or the borrower, or because of the rating migration. It could also be the case due to the rating migration, that the previous rating of the borrower was triple B. Let's say it was triple B, but now there is rating migration. Now it is reduced to or downgraded to C category. Now it is downgraded to C category, right? This is also the credit risk. We say to be credit option risk, but credit spread option or something, right? But this is also a credit risk. Okay, so whenever the rating of the borrower or let's say financial instrument is lowered, right, the spread over the risk-free rate increases. The spread will increase, and definitely the people will be wanting the more yield on the higher risk instruments, and definitely that will decline the price of the instrument. So whenever the interest rates do increase, the price of the instruments decreases. So you can get a very important inverse relationship that exists between the bond price and the interest rates. Bond price and interest rates are inversely proportional, that whensoever the interest rates do increase, there will be a lower bond price, and whenever the interest rates do decrease, there is an increased bond price. Is that clear to you? Right? So that's related to the credit risk and the counterparty risk. And if any of the parties or the counterparties default in completing the settlement, there can be a risk which is said to be the settlement risk. So that is said to be the settlement risk. Is that clear to you? Please confirm. After that, now let's discuss the management framework related to the market risk. Now we are having the different tiers. Like in the case of the normal risk, we can simply be telling the first point would be related to that we need to identify the risk, then we need to quantify the risk, right? First of all, the thing is what that we need to identify that what type of market risk is existing, and after that we need to quantify that what is the quantum, what is the amount of risk that is there, what is the price change, and how we can monitor it, how we can control it, how we can mitigating it. That's the whole process. That's the whole process. So the first thing, it's always related to the risk identification. Second one, it's related to the risk quantification or risk measurement. Third one, it is monitoring and control. And fourth one, it is a risk mitigation, that we want to reduce the risk overall. Okay. And after that, we are having the different limits in the banks. Like we are having the different limits and triggers. We are in the stop loss limit. We are in the risk monitoring frameworks and the other models for the analysis purposes, like value at risk, like duration, right? We are having the different models for the same. And let's now have a look at the organization structure. For the organization structure, first of all, the overall responsibility lies with whom? The overall responsibility lies with the board of directors. So even if we talk about any of the risk, the overall responsibility is with the board of directors. They do articulate the aggregate risk limits, review mechanisms, whenever we are talking about the procedures, policies, auditing systems, reporting systems, those all are articulated by the board of directors. Those all are articulated by board of directors. So whatsoever major thing is to be done, that is to be done by the board of directors, and the overall responsibility also lies with the board of directors, right? So they decide the risk management policy of the bank. They do set the limits for the liquidity, for the foreign exchange, anything, right? Those are all fixed by the board of directors. The second tier is related to the RMC, that is a risk management committee. Now risk management committee is the board level subcommittee. It is a subcommittee at the board level, and whenever the guidelines are to be set up related to the risk management, market risk management, that is being set up by the RMC, right? And if any prudential limit is to be set up, if robustness of the models related to quantification models is to be checked, that is also checked by the RMC. Proper manpower is available or not available, that is also being checked by the RMC, right? And also it's a responsibility of the RMC that are we conforming with the policy? Are we basically not, are we following the policy or not, right? That's also being done by the RMC itself. So the first one, it's the board of directors, BODs. Second one, it's the RMC. So articulation related work is being done by the board of directors. Implementation, or we can say that are we conforming with the part or not, that's being checked by the RMC. The robustness of the model is checked by the RMC. Manpower is checked by the RMC. Guidelines are being set by the RMC, right? And the third one, it is a ALCO. Very important. ALCO. Now, what is ALCO? It is Asset Liability Management Committee. Asset Liability Management Committee. So if we talk about the balance sheet management, transfer pricing, maturity profile, product pricing, that's all being done by the ALCO. So they are to manage the implementation of the risk policies and the business policies simultaneously. It's their duty, it's their responsibility so as to implement the risk policies, business policies simultaneously, so that we can be consistent with the policies which are set by the board of directors, and also we are consistent so as to achieve the objectives, right? So whether we are talking about the funding policy, transfer pricing, or maturity profile of the different assets and liabilities, that's all things related to asset and liabilities is to be checked by the ALCO. The fourth one, it's related to the ALM support group. It's the ALM support group, right? Now, ALM support group, as the name suggests, that is going to provide a support to the ALCO team, to the ALCO team. So they do monitor the things, they do analyze the things and report it to the ALCO, right? So whatsoever the market variable changes are there, they're going to look into those things, that what is going to be the effect related to those things, and they're going to report it that to the ALCO. After that, they are going to report it that to the ALCO. Okay. And the last one, the last tier for the market risk organization structure, this is the middle office. Now, middle office is responsible for the market risk monitoring. So in the very end, we can say front office kind of thing, overall risk management related to market risk. That's basically related to dealer room. Office, middle office is somewhat related to the dealer's room. We'll be learning all about the dealer's room also. So we are in the front office, back office, middle office. Now in that scenario, middle office is responsible for risk measurement, risk management and reporting purposes. And they also independently report the data to the ALCO, right? So they are basically working at the front office end and they do report the things to the ALCO, right? So they do provide the independent risk management. And whenever there is any policy, or let's say the ALCO is to change their tuning, right, related to control or anything, that's on the function or on the data or on the information that's provided by the middle office. And middle office functions independently. It functions independently, right? So that's about the organization structure. Is that clear to you? Have you understood the part so far? So if you have understood the part, kindly do give this video a like and share this video among your friends and colleagues. So first of all, it's the board of directors. The overall responsibility is with the board of directors. They articulate everything: stop loss limits, review mechanism, reporting mechanism, auditing systems. That's all being done by the board of directors. Second one, it's the RMC, Risk Management Committee, board level subcommittee. RMC is what? RMC is the board level subcommittee. So as to check the manpower that's available or not, proper robustness of the systems is there or not, risk management processes conforming to the policies or not. That's a duty of the RMC. Then ALCO, that is Asset Liability Management Committee. So as to check and to implement the implementation of the risk policies and the business policies simultaneously, that we have to achieve the objective and we have to follow the guidelines, right? So even if it's related to the transfer pricing, maturity profiles, product pricing, balance sheet management, that is done by the ALCO. That's done by the ALCO. ALM support group provides monitoring and analysis and reports to the ALCO. They are going to examine the all the parameters or different variables of the market risk, and they do recommend the actions to the ALCO, right? Further, the last one, it's the middle group. They provide the independent review, independent monitoring, analysis related to the market risk. They are working at the front end in the treasury departments, right? And they do work independently. And they do work independently. I hope that you must have understood the concepts related to it. If clear, so do like the video and further share the video at the earliest, and simply just do write CAIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIB, just simply do WhatsApp CAIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.